Today, we're completely reframing how you look at money. We're not going to talk about financial magic, luck, or some exclusive rich person's secret. Instead, we're going to look at wealth building as a pure, simple mathematical function. Honestly, if you understand basic pre-calc, inputs, outputs, slopes, and variables, you already have all the tools you need to build serious wealth. And that brings us to our central question. What if the secret to building wealth isn't actually about how much you earn from your salary? What if it's simply about how you plot your money on a graph? We're going to look at investing strictly through the lens of mathematics today, specifically comparing linear equations to exponential ones. This right here brilliantly illustrates the two fundamental mindsets of money. Let's look at two hypothetical US workers, Ben and Grace. They're the exact same age, they earn the exact same salary, and they both set aside the exact same amount of money every single month. But Ben has a linear savings mindset. He puts his cash into a standard bank account. In math terms, he's basically operating on a linear equation with a slope that's practically zero. His graph is just flat. Grace, on the other hand, has an exponential investor mindset. She puts her money into the market. So her money is operating on an exponential function, where time acts as this massive multiplier. Now look at the massive divergence in their mathematical outputs after a few decades. Ben's flat, linear slope earned him barely anything over his initial inputs. But Grace's exponential curve, it generated a massive output of $1.8 million. Think about that. They started at the exact same point on the x-axis, but the mathematical vehicle they chose dictated entirely different outputs on the y-axis. The flat slope of a savings account literally just gets crushed by the exponential curve of the market. All right, let's move on to our next section, defining the S&P 500. To create an exponential wealth function, you need the right variables, right? And in the investing world, the S&P 500 is the ultimate variable set. Think of it as a dynamic basket of the 500 largest companies in the United States. These are the variables in your wealth equation. Instead of risking everything on one single variable, like betting your entire life savings on one stock, the S&P 500 completely diversifies your equation. You're spreading your input across 500 constantly updating variables, including absolute titans like Apple, Microsoft, and Amazon. So if one variable fails, the rest of the equation holds strong. Now, you might be wondering, how does this function actually generate an output? Well, it does it in two ways. First up is capital appreciation. That's the actual value of those variables increasing over time. Second is dividends. This is when companies pay out regular, actual cash bonuses to their investors. When you add these two together, boom, you get your total mathematical return. Which brings us to the slope of our long-term exponential function, 10 to 11%. Historically, looking back over the last 60-plus years, the S&P 500 has averaged an annual return of about 10 to 11%. Now compare that to a bank account yielding maybe 0.10%, all while inflation is eating away at 4 to 5% of your purchasing power. Mathematically speaking, leaving your money in the bank is actually a negative function. The S&P 500, however, gives you a positive, historically proven upward slope. Okay, moving right along to our next section, the compound interest function. Now that we have our variables and our slope, we've got to introduce the core scientific principle driving this entire wealth building machine. We are talking about compound interest. It is an exponential function where your money makes money and then that newly made money makes even more money. In algebra, think of this as an iterative mathematical loop. The output of one cycle automatically becomes the much larger input of the next cycle. It literally feeds on itself, growing steeper and steeper as it moves along the x-axis. Let's look at a concrete example, because this will absolutely blow your mind. Here we're comparing Anna and Beth. Anna started investing at age 22. She invested for just 10 years and then stopped entirely, just left it alone. Beth waited until age 32, but she invested continuously for 30 years until age 62. Notice the final outputs here. Anna has $9.1 million, while Beth has $4.5 million. Crazy, right? Anna put in drastically less money, but because she shifted her function to the left on the x-axis, just by starting earlier, her exponential curve had way more time to compound. Time is hands down the most powerful multiplier in this entire equation. And this quote just perfectly summarizes the math. The most important day of your investing life is not the day you have a large capital. It is the day you start. Every single year you wait is a compounding cycle you can never ever get back. You don't need a huge input to begin. You really just need to begin the function. All right, let's look at how we put this into practice. Section, solving dollar cost averaging. So we know the math works, but how do we actually input our money into this market function without letting human emotion completely ruin the equation? The answer is a protocol called dollar cost averaging, or DCA for short. It's the regular investment of a fixed dollar amount at strict intervals, totally regardless of what the market graph is doing. You don't try to guess the highest point, you don't guess the lowest point, you just create a constant operational rule for yourself. Say, investing on the 15th of every single month, and you execute it mechanically, like clockwork. Let's put DCA into action so you can see it. Every month, you input a fixed $200. In month 1, the share price happens to be high, so you buy fewer shares. Okay, fine. But notice month 2 and 3, the share price drops. Because your input of $200 is fixed, that same exact amount of money automatically buys you more fractional shares when the price is low. It's brilliant. You are mathematically turning a negative market domain into a distinct advantage. So the crucial takeaway here is this. Market dips are not a negative domain to fear. They're really not. They are mathematical opportunities to buy more variables at a massive discount. The S&P 500 has recovered from every single historical crash, the 2001 dot-com bubble, the 2008 financial crisis, the 2020 pandemic. Over the long domain of time, it always corrects upward. DCA ensures you're accumulating the most assets during those dips. Okay, moving on to our next section, the variables of investing. Let's transition from theoretical precalculus to the practical, real-world variables you need to actually set up this equation today. First, we have to cleanly separate our variables into two categories, liabilities and assets. Liabilities are your negative variables. They literally subtract from your equation. This is that new car that depreciates the second you drive it off the lot, the latest expensive gadget, or credit card debt. They constantly drain your cash flow. Assets, like S&P 500 index funds, are positive variables. They add to your equation by generating capital appreciation and dividends in the background without you having to lift a finger. Ultimately, wealth is simply maximizing assets and minimizing liabilities. Now, when you buy an S&P 500 fund, there is one negative friction variable you absolutely must control, and that's the expense ratio. This is the annual percentage fee taken by the fund manager. In our mathematical model, lower is always, always better. A high fee might look tiny today, but remember our lesson on compound interest? Yeah, that fee will also compound over a 30-year domain, eating massive, massive chunks of your final output. And that is exactly why this number is so beautiful. 0.03%. This is the expense ratio of highly popular S&P 500 ETFs like VOO or IVV. To put that into perspective, it means that for every $10,000 you invest, you are only paying $3 a year in fees. It's practically free. By choosing funds with incredibly low friction variables like this, almost all of your capital remains trapped inside your compounding loop, doing the heavy lifting and growing for you. So how do you actually execute this? It's a ridiculously simple 3-step operational procedure. Step 1. Open a U.S. brokerage app on your phone. Think Fidelity, Vanguard, or Robinhood. Step 2. Fund the account. Step 3. Buy fractional shares of an ETF like VOO or IVV on a regular schedule. And the absolute beauty of fractional shares is that you don't need hundreds of dollars to buy a whole share. You can literally start calculating wealth and plotting points on your graph right now with just a few dollars. Okay, final section. 5 errors to avoid. Before we wrap up, we've got to talk about preventing logic errors. Because in math, extraneous solutions can break your entire equation. And in investing, human emotions do the exact same thing. Here are the 5 fatal math errors you absolutely must avoid. 1. Checking your portfolio daily. This is a long-term equation, guys. Daily noise will only cause you unnecessary anxiety. 2. Panic selling. Selling when the market is down locks in your losses and completely ruins the compound function. 3. Timing the market. Waiting for the perfect time mathematically loses to continuous dollar cost averaging, every time. 4. Investing short-term cash. Only invest money you won't need for the next 5 to 10 years. And 5. Chasing trends. Stick to the proven S&P 500 formula. Leave the gambling out of your math. We've covered the numbers, the slopes, and the functions. But honestly, all the math in the world means absolutely nothing if you don't calculate the very first step. Just remember, the distance between dream and reality is called action. Passive learning must now become kinetic execution. I'm going to leave you with this final, provocative thought to ponder. Your financial equation is just sitting there, waiting to be solved. The x-axis of time is moving whether you like it or not. So what is your first variable going to be today? Are you going to stay on that flat linear line, or will you jump onto the exponential curve? That is all for this explainer. Now go plot that first data point.